Good afternoon, everybody. Okay, let's get things started here. And let me share my screen here. And let's share this fun. And let's get my PowerPoint up here. Okay, so here we go. Okay, so everything mortgage changes in relation to COVID-19, how it's kind of impacting our world. Okay, so first thing here, let's get to the next, because I thought this was kind of fitting to kind of, pessimists complain about the wind. The optimist expects it to change, and the leader adjusts the sails. So for those of us here in the real estate and the mortgage world, where we're kind of running our own business, let's be the leaders and adjust our sails to these changes. There's nothing we can do about it, so we have to play along. So we may as well play along as best we can. Okay, so forbearance. Everybody's been hearing about forbearance. What is forbearance? A forbearance is an agreement between a homeowner and their mortgage servicer, which is where they send their payment, to suspend payments for a period of time. The homeowner does not incur late fees or other penalties during forbearance. Now, there's been a lot of talk out there about, hey, it's like a furniture payment. It's deferred for 3 or 4 months, but at the end of that 4 months, you owe the entire balance. So that's not necessarily true. This is right from Fannie Mae's website. Forbearance does not mean your payments are forgiven, as we just noted. You're still required eventually to fully repay your forbearance, but you won't have to repay it all at once unless you're able to do so. So contrary to a bunch of stuff that's out there, Fannie Mae says, no, you don't have to pay it all at once. Now, for safety's sake, all the servicers are going to treat this slightly different. So you need to check with your servicers and find out, what exactly they're going to do. Okay, so loan servicers are given these instructions from Fannie and Freddie, ensuring payment relief for providing forbearances for up to 12 months, waiving assessment and penalty fees, as we just noted, halting foreclosure. So anybody that might have been in a foreclosure, that stuff's going to be halted until May 17th. And that date was chosen based on, 30 days ago, based on the curve at that time. So these things are fluid, they're in motion. So May 17th, that could be pushed off anyway. But foreclosures were super low. They were like 0.4%, I think is what they were. Okay, suspend reporting to the credit bureaus of past due payments of those in forbearance due to COVID emergency. So something super important, we'll talk about that a little later as well. Offering loan modifications for payment relief to keep mortgage payments the same after the forbearance period. And borrowers are eligible regardless of whether the home is a primary home, an investment home, or a second home. Okay, so this is something I want to kind of put things in perspective. The government's been giving trillions of dollars in injections into our economy. Back in 2008, 2010, it was billions, and now it's trillions. Let's put that in perspective. 1 million seconds is 11 and a half days. A billion seconds is 31 years. A trillion seconds is 31,000 years, almost 32,000. Think about how much money the government is injecting into the system, the difference between a billion and a trillion. So it's just a staggering amount of money that we can't even conceive. Okay, so forbearance and the CARES Act. So the CARES Act covers and talks about the government-backed mortgages, which would be VA and FHA. And there's not a whole lot of information on these, but it just falls back to the servicer, right? You have the right to request a forbearance, right to request an extension up to an additional 180 days, the first one being 6 months, the first request. And of course, you got to contact your loan servicer to request the forbearance. Okay, questions to ask. So inform everybody, realtors and your friends, hey, inform that these are the questions you should ask. Will we owe the entire unpaid balance in a lump sum once the pause period has ended, or at the end of the loan term, or how's that going to work out, right? Can the loan term be extended so missed payments are added to the end of the mortgage? Will subsequent monthly payments be higher for a period of time to make up the deferred amount? And how will this impact my credit, right? So Fannie and Freddie says, hey, suspending of reporting, but a mortgage is either paid as agreed or not. So this forbearance is not paid as agreed. So there could be a banner on there saying, I don't know, right? We're in uncharted territory. So definitely ask your servicer what they're going to do. Okay, and gosh, super important, right? Watch out for scams. There's going to be fraudulent calls out there, emails, text messages, offers in the mail, offering you all kinds of stuff, and boy, certainly watch out for scams. Okay, so let's talk about the chaos that the Federal Reserve threw into the industry when they began to buy mortgage bonds. So I don't know if anybody has seen this before, but this is a normal mortgage bond chart, and this is the price of bonds. And they're nice and steady. Price of bonds have been going up, 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 which means rates were going down, down, down. And then we kind of flattened out here a little bit. But then when the government jumped in a couple of weeks ago, rates were all over the place, up, down, up, down, up in the same day. I mean, we saw just massive swings in one day, and we'll talk about that here as I continue along. But I thought this was kind of funny. Somebody saw that on Facebook and sent it to me. Okay, so locking, hedging, servicing, and margin. And what does this mean to the industry? So when a loan is locked, it's a commitment between the lender and the borrower to honor the rate lock at closing. So if I lock your rate today at 4%, we're going to honor that interest rate in 30 or 60 days. But the loan's not delivered for 30 or 60 days. So what happens between the time that we lock and we have to honor the rate? What if rates go up or down? So what lenders do is they do something called hedging their position. So it's taking a short position or the opposite position. So if I quote you a rate today of 4%, we're going to honor that 4% in 30 days. If rates go from 4 to 4.5 in the meantime, that means as the lender, I have to honor the 4%. So I have to buy your interest rate down from 4.5 to 4%. If rates go the opposite way, you would think we make money, but because of this hedged position, our dollars, the hedge is just part of the cost, right? So if I hedge and rates improve, I lost the money on the hedge, but rates improved, so I'm a wash. Or I made money on the hedge, so it's a wash. And if rates go up, I have to pay, but I made money on the hedge, so it's a wash. So we hedge our position, so if rates go up or down, it's essentially a wash to us as far as the cost is concerned. Okay, servicing. So lenders that service loans, they pay for that servicing. They pay about 1% to service a loan. So if a loan amount's $300,000, they pay 1%, that's $3,000. And they make about 30 basis points per year, which is $900. So it takes about 3 years to recover that money. So this is an asset to a lender, and it's money that they expect to receive. So as a servicer buys servicing, and it's profitable, and it's been pretty guaranteed because people have been paying their mortgages for a solid 10 years. So sometimes they'll go out and borrow money to get more servicing. When I see I spelled borrow wrong there. So the servicer leverages, or they borrow money to obtain more servicing because it's steady profit and the high probability of payback. But that's a problem when interest rates get really volatile and there's what's called servicing runoff. So when loans are paid back sooner than expected, especially in mass quantities, margin calls begin, and that causes the liquidity concerns. So remember when I said they borrowed money? So if they borrowed money and then loans are being paid back too quickly, the person that lent the money, called the broker dealer, says, hey, you owe me a bunch of money here. You got to fund your account because I'm getting too skinny here. So, and this really happened from March 9th through 12th and then the ensuing date. So I put that there just to remind me to talk about it. So forbearance obstacles for servicers. So this allows deferment of the payment. However, the servicer must still pay the investor, which creates an enormous obstacle. Fortunately, there's been a new facility set up to help the mortgage servicers bridge the gap to the investor. However, it's unclear how long it will take for the servicers to actually access this facility. So what this means is forbearance allows deferment of the payment. But the servicer, so Vince Mazzacco services your mortgage, I still have to pay the end investor, right? That there's no way around that. Well, you didn't pay me, so how am I going to pay the investor? Well, under normal circumstances, hey, there's certain people that can't make their payment. I have the cushion to do that. But if thousands of people aren't going to be paying me and I still have to pay the investor, that's a problem. So we'll have to wait and see how that vehicle works out to bridge the gap between the servicer and the investor. But what has not yet been contemplated is the fact that the borrower who does not make their very first mortgage payment causes the loan to be ineligible to be sold to an investor. And this means that the servicer has to hold the asset itself, which ties up their available credit, because a lender puts a loan on a line of credit, and then we sell it off at the end of the month, freeing up that line of credit. But if this loan doesn't get paid in its first payment, then that ties up my available credit, which then I can't issue more loans because now my credit line is tied up. So with so many new loans being originated as of late, the amount of these transactions that will not qualify for sale is significant. This restricts the lender's ability to clear their pipeline or our line of credit and get reimbursed with cash so we can fund new loans. So that's what forbearance does, and that's that liquidity issue that I'm talking about. Okay, so the liquidity crunch, March 9th. Okay, so the stock market had sold off a little bit. In a couple of weeks, we dropped 10%. But then in a matter of a few days, we dropped another 20%. And here's where an additional liquidity crunch came in. So this is the peak of the S&P 500. And then March 12th is right here. Or I'm sorry, March 9th is right here. So I'm going to go back a page. So here's March 9th. And then watch the fall off here, all the way down, right? From here to here. So from March 9, 10, 11, and 12, we see a sell-off. This is not normal. So as the stock market began to sell off, the stock market started to sell off, okay? So as the stock market sells off, the price of bonds go up because the stock market's selling off, so people have cash. They stick it in bonds because bonds are safe. So the price of bonds go up. This is normal. So as the price of bonds go up, interest rates go down. Now, when the stock market began to sell off on March 9th, the bond market also sold off because of the liquidity that I was telling you about. So people were looking for liquidity because of these margin calls. So as the stock market sold off, the bond market was being sold off as well, and so was gold. So all this stuff is being sold because lenders had to give margin calls of hundreds of millions of dollars to their broker dealer, and that's what caused this sell-off. So then the Fed jumps in and thinks, hey, we need to rush to the rescue here. We better start buying some mortgage-backed securities, MBSs. So they buy $88 billion in mortgage-backed securities, which make the price of bonds jump 170 basis points. 170 basis points. This is 0.3% swing in one day. And then I'm not going to get into each one of these boxes, but as the government started buying bonds, they're absorbing, they're putting some liquidity back in, but the amount of runoff here is just incredible. So we're seeing these huge swings in interest rates in one day. Here's 380 basis points swing in one day. On this day, I quoted somebody 3.25 in the morning. In the afternoon, I quoted them 5.125, I think, or something like that. It was almost a 2-point swing in the same day. So this is a serious problem for loans that we're closing here, right? Because if I locked somebody at 3.375 here, and today I'm closing and it's 5.25, I have to pay 3 or 4 points to honor my lock. But my positions, my hedge got totally screwed because of all of this buying of bonds that I wasn't expecting, creating all this volatility. So I'm all over the place with my hedges. So then the government said, oh my gosh, we're still not helping. So then they really jumped in and really drove, because what they're trying to do is keep mortgage rates low. So they're jumping in, buying bonds, trying to drive the price up to keep interest rates low so people continue to refinance. But they didn't realize there was this other problem going on with the liquidity and capacity issues. Rates got so good, lenders just got locked up with capacity. And I have a bunch of lenders that are locked up with capacity right now. So then they jumped in. They were just buying, 6 billion, 4 billion. Here was a huge day. But they were buying, much smaller dollar amounts. And then all of a sudden they jump in 40 billion, 36 billion, 36 billion, 41 billion. And this week they bought $180 billion worth of mortgage bonds. That sent the price higher, which is supposed to drive the interest rate lower, which is what they were trying to do. But lenders didn't have the capacity. And because of all this margin calls where they lost money and all their hedges, they lost money and capacity issues, they stopped offering a better interest rate to the consumer. So even though the Fed accomplished their goal by driving pricing up, they didn't realize the problem they caused in here, and it just created all kinds of muck. So in any event, since then, we've now balanced out. So Barry Habib, who's the genius in the country with mortgage bonds, he got the word out to the Federal Reserve, hey, you're totally messing with the market and you're killing us. So they actually totally slowed down their purchases, and then the price has since balanced out. So we're not seeing the massive swings anymore. Okay, so let's talk about guideline changes. So conventional, the biggest thing out there right now is re-verification of employment. So if you're a realtor and you've got a buyer that's closing, find out when the lender's doing their variable verifications of employment. Fannie Mae wants them 40 hours before the note date, but some lenders have an overlay and they want it done the same day. And this must come from an email directly from the employer's work email address, identifying the name and title of the verifier, or a verbal verification from a number that's verifiable. So I can't just ask Kim, hey, what's your boss's cell phone number? Well, that cell phone number is not verifiable, right? I need to be able to do a Google search and verify that that number belongs to the organization. So, and those people are busy, right? They're in Zoom calls or meetings, and so they might not be able to reply right away. So this is something you can stay ahead of the curve and find out, hey, when are those verbal verifications being done, so you make sure you meet your closing date. Tax transcripts, these are no longer available. The IRS is shut down in this capacity. So if needed, the borrower needs to obtain them. This is generally only for self-employed borrowers. There's a lot of W-2 people where we don't need these anymore, but certainly for self-employed borrowers, or maybe that's somebody that's got income on a tax return that we're using, excuse me, then in that situation, we're gonna need transcripts. Overlays. So some lenders are cutting self-employed borrowers' income by 25%. They're requiring reserve funds. So after closing, they have to have 3 months or 6 months of mortgage payments in reserves. And that could be dependent on credit score, debt ratio, the amount of down payment. So there's a lot of miscellaneous things that are going on. So again, if you have a buyer in process, somebody that's been approved and they haven't bought a home yet, make sure they circle back to their lender and find out, does this impact them at all? Proof of liquidation of assets. This isn't something we've had to do in the past. Depending on how much money's in an account. So if somebody's using their Amazon stock as their down payment, and they give me a March ending statement, they may not have the same amount of money today in that account because of the volatility. So now we want to see proof of liquidation. So these are things you can, again, stay ahead of your closings. Find these things out to stay ahead of your closings to see if that stuff's going to be needed. So now Fannie Mae and Freddie Mac allow for remote online notarization, which means using Zoom, just like I'm doing right now. However, there's a lot of title companies that don't allow this, and some lenders don't allow it too. So I just had one the other day. A guy was stuck in Canada. I think it was First American Title, and I reached out to him and said, hey, listen, can you do Zoom and meet the guy face to face? And they said, no, First American doesn't allow it. So I was hoping we were going to be able to do it just, over the phone instead of having to the borrower go find a notary up in Canada. Okay, additional overlays. So Chase just came out and set the bar at 700 FICO score. So if your FICO score is not 700, you ain't getting a loan. And I heard that some retail mortgage bankers may follow suit. So again, have your borrowers check in. We're in the broker world, so if I have a lender that has this overlay, I can just go to a different lender. FHA, let's talk about their changes. Most lenders have increased their credit scores from 640 to 660. So there's still a few out there at 580, but quite honestly, if it's at 580, to get a reasonable interest rate, 5%, they're probably gonna have to pay 5 points just to get 5%. So it may not happen. Reserve requirements, depending on the debt ratio and credit score, you may say additional payments are needed for reserve requirements. And then FHA is a little bit looser with their re-verification of employment. Sometimes it can be waived if the borrower has 3 months of payments in reserves, or if we get the most recent pay stub that just cut off yesterday and we're closing tomorrow or the following day or Monday. Or if we have an updated bank statement that shows a direct deposit, but sometimes those aren't super easy to get because they're not available. And then VA didn't really have too much in the way of overlays. Okay, so let's talk about appraisals. Everybody's kind of in the same boat here. Social distancing, Fannie and Freddie, FHA and VA pretty much allowing a traditional appraisal, a desktop appraisal, or exterior. I think everybody knows what traditional and exterior are, right? Exterior means they drive by the house. A desktop is they're sitting here at their desk just like I am. They're going to look at the MLS. They're going to reach out to the listing agents and the buyer's agents. Say, listen, tell me about this property. Are the photos in the MLS accurate? Pulling up some county data, and then actually just doing a desktop appraisal. FHA, most of the cases, they're going to allow a desktop or drive-by. And then HECM, that's your home equity conversion mortgage, which is a reverse mortgage. And purchase transactions to use exterior and desktop only appraisals. Exterior only appraisals on a limited instance, and a desktop appraisal for VA. Okay, so that pretty much covers everything that I just kind of wanted to go over. If you guys have any questions, don't hesitate to give me a buzz. If you'd like access, I have a bunch of links where I pulled all this information right from Fannie Mae's website and HUD's website. So shoot me an email, DM me, text me, whatever, and we'll get the information over to you. Okay, hope you learned something today, and make it a great day.